Okay. Hey, good afternoon, everyone. I'm John Gemini, Regional Vice President of Sales here at Angel Oak Mortgage Solutions. I want to thank you all for joining the webinar today. It is just the top of the hour, so we're going to give about another minute for everyone to log in. We've got well over 400 people registered for this webinar, and this is the 8th in our series, so we appreciate everyone taking the time out of their day to expand their knowledge of the non-QM space. So I'll introduce our panelists in about a minute and a half. So thank you everyone for joining us. So guys, I'm located here. For those of you that don't know, I'm located here in one of our ops centers, and it's in Dallas, Texas. So we have 2 ops centers headquartered in Atlanta, and this is a regional ops center for us. So unfortunately today in Dallas is a little overcast, but we're looking forward to kind of educating everyone on non-QM space, and we just rolled out some more enhancements on Friday. So we're looking forward to Russ and Jill sharing those enhancements with you guys. So give us about another minute. We still have a lot of people logging in. So we look forward to getting this started in about 45 seconds. Thank you, Adam, for joining. Looking at some people here, see if I recognize any names. All right, guys, we'll get started here in about 30 seconds. Look forward to it. We have a question box for everyone to use. Please feel free to ask any questions during this. We will answer all your questions. If we don't answer them live today here, we will reach out to you by end of day tomorrow to get those questions answered. For all of you who are attending this is being recorded, and we will send this out before end of day tomorrow. So get started here. It's 2 minutes after the hour. Let's get started again. And thank you everyone for taking time out of your busy day. We all know that you all been crushing it the first, third of this year. So we look forward to helping you continue to grow your business throughout the remainder of 2021 and into 2022. So today I have a couple of subject matter experts with me today. I want to introduce Jill Polche with us. She's an area sales manager for us here at Angel Oak Mortgage Solutions. Jill, please introduce yourself.
Hi, Jill Polche. I'm in the San Diego territory area. I've been doing non-QM with Angel Oak for a little over 2 years, and I'm portfolio lending and non-QM type stuff about 10 years total.
And just, Jill's being pretty modest. She's been with us just over 2 years. She was the top producer last year and was recently promoted to an area sales manager. So congratulations, Jill. So Russ Wright, please introduce yourself.
Thanks, John. My name is Russ Wright. I'm the area sales manager and based in Portland, Oregon. I've been with Angel Oak for about 3.5 years now. Started back with Angel Oak after a little time out of the business, but have about 14 years total experience in non-QM lending and subprime. I'd say the one thing that's really intrigued me about Angel Oak from the onset is a real focus on process improvement and continuous process improvement, in technology and product and everything else. So it's been a lot of fun. We've got a lot of good products to go over with you guys. I'm excited to be here. Thanks.
Yeah, thank you, Russ. And Russ was also just promoted to area sales manager, so you guys got some all-stars here with you. So what we're going to do here today, it seems like, since March of last year when COVID really impacted everyone in the world, Angel Oak took a little bit of a pause here for about 45 days. We relaunched our programs in late April 2020. And since then, we've had 27 enhancements within the last year. So, everyone's hungry for information on what's out there, what's not out there, what's available, how can you help me close some more loans. So that's what we're here to accomplish today. And for everyone who's jumped on, we've got almost 200 people on this call right now. So this is going to be a deep product dive, and we really want you to use that question box to get your answers, get your questions answered personally. So, and if we don't get to your answers today, we will have a local account executive reach out to you and get your answers no later than end of day tomorrow. So again, this isn't about us talking about all the securitizations we've done. I think we've done about 12 or 13 securitizations since we launched. It's not about Angel Oak being the leader in the non-QM space since 2013. And, you know, so it's really all about a deep product dive and how we can help you guys close some more loans in the rest of this year and into 2022. So first question out of the box is, you know, what's the difference? What makes a non-QM loan? Well, the difference between non-QM and QM, there's a few highlights there. You know, we still have to abide by the ability to repay. We may use alternative income documentation, but we still have to abide by the ability to repay. There's restrictions on QM, 30-year term. We allow 40-year interest only. Also, points and fees that can be charged to the borrower. QM is capped at 3%, and non-QM is capped at 5%. And then last but not least, DTI. Usually DTI on QM is capped at around 43%. We'll allow you to go up to a 50% DTI. So great questions. Please keep them coming. Well, let's go right into our website. Hopefully everyone's viewing our website. It's very clean, easy, very intuitive, easy to use. But we're going to go in. We're going to show you a couple of tools at the end. Also, some really neat tools that you can access 24/7. And then we're also going to talk about some really, really great marketing tools that we can help you grow your business. So without further ado, we're going to start with our bank statement program. And here's this, Jill's going to give us a high-level overview of our bank statement program.
Okay, thanks, John. So our bank statement program is definitely our most popular as far as volume goes. And it's really your go-to option for self-employed borrowers who don't qualify for traditional full doc tax return financing. So the cool thing about this is we do pre-qualify your borrower as much as we can up front. We'll get into that a little bit later about how that process works. It's a 24 to 48 hour window, and we do a really good scrub to know, is your loan going to work? And you're pretty much done at that point as far as qualifying. So parameters of the program is we will go down to a credit score, a minimum of 640, and we go up to a max LTV of 90% with no mortgage insurance. We don't actually have mortgage insurance on any of our non-QM programs. So it's a nice little benefit that we have there. The max loan size does go up to 3 million. That 90 LTV I just spoke about goes to 2 million, but we'll do loan amounts up to 3 million, sometimes more case by case. We look at compensating factors as far as credit score, previous home ownership, and things like that. And the way we kind of look at the bank statements is, as you can see here, we'll look at either 12 or 24-month statements, whether personal or business. And then some little highlights about the program is that everything's 30-year fixed. We do require that the borrower be self-employed for at least 2 years to count as self-employed. And also, our definition of self-employed means that at least 30% of their total income comes from self-employment sources, whether that's ownership in a business, or they're 1099 or whatever it is. And then next bullet point you can see here is that if you're using business bank statements, we do require that the borrower be at least 50% owner. If you're using personal statements, we don't have that same requirement. But again, 30% of their total income needs to come from self-employment sources. If they are using, if they have a business account and they're using personal, they do need to be 25% owner of that business. We do the standard transactions, purchase, rate term, cash out on all occupancy types, owner occupied second home and investment. We actually also have an option to go just straight 1099 if they have solid income on just their 1 or 2 years 1099 forms themselves versus looking at the 12 and 24 months bank statements. And another cool feature we have is we do allow interest only. So interest only is allowed right now on the owner occupied and second homes up to 85 max LTV. And it's a 10-year fixed IO period, and then it converts to a 30-year fully fixed or fully amortizing loan. So it's a 40-year term total. I kind of touched on all those highlights, I believe. And then I guess the biggest question people always want to know about is how we're going to calculate the income. How do we look at expense ratio? So as a general rule of thumb, we'll look at 50%. So if your total qualifying deposits work at 50%, that's the amount we're going to use, and we don't require any P&Ls or additional documentation regarding what the true expenses are. There are some limitations on this, as you can see the bullet point down here. Larger businesses with lots of locations or high inventory and high traffic, we will do at a 70% factor currently. That includes retail shops, typically some restaurants with larger employees and amounts of inventory, and gas stations and some new home builders. This is all stuff you can go through with your account executive. They'll walk you through the process and kind of give you an idea of what you're going to be looking at as far as expense goes. And again, that's all done within that 24 to 48 hour window. So it's very fast and efficient.
Yeah, Jill brought up something really important early on. You know, she said that we're going to pre-qual this up front, so there's not going to be any surprises. So I really want to make sure everyone on this call realizes that you're not going to work with an account executive that's not going to publish or is not going to publish a pre-qual without really going through that. And just to kind of add, you know, these are high-level guidelines or characteristics of the bank statement loan. You know, 30% of the loans Angel Oak closes do not meet our guidelines. So what does that mean to you? You know, we didn't talk about, you know, I said all the securitizations about our vertical integration. We know the kind of loans our capital side wants to invest with Angel Oak. So about 30% of the loans we close don't meet our guidelines. So why is that important to you? We're not going to the end investor. Angel Oak Capital is the end investor here. So we know up front, you're not going to get it clear to close and then get 2, 3, 4 additional stipulations or have income calculated a different way. So Ross, discuss, you know, how does that income get calculated for the borrower on behalf of the loan officer?
Yeah, thanks, John. So we've got a really great process where you submit the 1003, the credit, and the bank statements to us. And as Jill mentioned, it's either 12 or 24 months of either business or personal. And there's a small price difference between the 12 and the 24 of an eighth in rate. Once you submit those to us, we give those to our review team, and they actually go through and comb through all the bank deposits and come back and tell us what the allowable deposits are that you can use for income for the borrower. So it's a really smooth, seamless process. And as Jill mentioned, you know, we've done probably 50% of our business to date, you know, give or take, on the bank statement program. And a big part of that is because of the ease of the process. So like I mentioned at the beginning, even with the guidelines that we've had in the past, we've done those volumes, but we just recently made some adjustments, I think, as John mentioned earlier, to where we've reduced the credit requirements on this now to where we can look at borrowers that have had a bankruptcy or a foreclosure as little as 2 years back. So potentially, I mean, think about this from an opportunity standpoint. You've got scores down to 640. You've got loan amounts up to $2-3 million, and with a credit profile of bankruptcy or foreclosure as short as 2 years back. And on Chapter 13s, we'll actually go from the filing date of the bankruptcy rather than the discharge. So, you know, you look at, you know, in Oregon alone, there's about 350,000 self-employed borrowers. You know, just in our little state up here in the Northwest. You know, when you think maybe 5-10% of those have actually taken advantage of this type of program, it really creates an amazing opportunity. So I'd recommend really getting familiar with this. If you have any questions, reach out to your account executive in your local market, and they can really help make this a differentiator for you.
Yeah, Russ, you mentioned about, you know, how many people up in the Northwest self-employed. There, just as another statistic I want to share with everyone, there are more self-employed borrowers than there are VA borrowers. So you talk about an untapped market, and I accidentally did not do our poll question, what we usually do during this. But when we do it, we usually ask how many people have closed, you know, a bank statement loan in the last 12 months. And statistically, we've done, this is our 8th deep product dive. And statistically, it comes out to about only 20 to 25% have actually closed a bank statement loan within the last 12 months. Guys, there's such an opportunity. So you take how many people, more people are self-employed than there are VA, and then you say there's only 25% at the top end that have actually closed a bank statement loan. There's a lot of underserved self-employed borrowers out there. Throw another statistic out there. Heard on one of the financial shows the other day, small business applications, so self-employed people applying for a business application in 2020 increased over 25% over 2019. So look at the future of the self-employed borrower. That's not slowing down. So either get comfortable doing these programs or get comfortable doing bank statement programs, and you don't have to do anything. As Russ and Jill presented to you, we'll look at the credit. We'll look at the 1003. We'll calculate the income for you up front. So I'm done talking. I've got to get a couple of questions answered here from our audience. So Jill, I'm going to throw the first question out to you. And Rob, thank you for asking questions, and we're going to get to all these. This is being recorded. If we don't get to your questions today, we will reach out to you. If not before the end of the day today, definitely by tomorrow. So Rob asked the question, what if a borrower has 10 businesses and they want to use all 10 business bank accounts? Jill, help us help Rob.
So I always like to say we're the cookie cutter of your bank statement loan, but I still think our process is the best. We will consider up to 2 businesses for a borrower, but we need to do a thorough analysis and make sure there's no commingling of funds. Otherwise, you're kind of manipulating the true cash flow. So that's the max we'll allow. I always say go where the money goes. So whichever business the borrower has the highest % ownership of and the most deposits, we're going to look at that first, see if our 50% flat expense ratio works. If not, we can go lower with the CPA letter documentation that the business true cash flow is under a certain percent. Right now, our minimum is 30. We're looking at lowering that even further, depending on the type of business. But that's kind of where that's going to go as far as the question that you asked.
Yep. Yeah, so great. Thank you, Jill. Some of the other questions that I'm getting here, will guidelines be available? No, your account executives are basically your non-QM help desk. We've got probably close to 70 account executives throughout the country that are here just to serve you and your needs. So, but we'll show you a couple tools later on down the road that will really, really help you. Russ, so what if a borrower is using personal bank statements and the spouse listed on there is W2? How do we get that deal done?
Yeah, that's a great question, John. So basically, we can use both sources of income. If we're using the personal statements, in effect, it's going to wash. We're going to back those W2 deposits out of those bank statements, but then we'll give them credit for it on the full doc side. You could also have a scenario where you have 2 business owners that are applying together. So we'd be able to use the income on both of those. The big thing is, as Jill alluded to, we want to make sure that there's no commingling and circular deposits, so transfer of funds back and forth. As long as that's very clear, we can do both of those scenarios.
All right. Thank you, Russ. Guys, keep the questions coming. Jill, talk about, I mentioned it earlier about the QM, non-QM. What people are asking, what's the DTI on these programs?
Sure. So we have a front end max ratio up to 40%. So that's just your housing expense, the PITA on the housing. And then the back end will go up to a 50% for your total debts, which is higher than most traditional jumbo, particularly.
And then, Russ, a couple other questions coming in. What are the trade line requirements?
Yep, for trade line requirements, we're going to need 3 open and active for 12 months or 2 open for at least 24 with activity in the last 12. And also, I wanted to add, kind of back on what you said, John, about the number of people that have actually done one of these bank statement loans to this point. I think the big opportunity with all of our products and in the market in general is the opportunity to differentiate yourself, with your customers and with your referral sources. So if 25% of the loan officers in the market right now have done a bank statement loan, if you go talk to your realtors or your CPAs or your financial advisors, your sources for your referrals, figure maybe a tenth of that they've got working knowledge of this. So in a lot of cases, they don't even know that these programs are available. So it really presents an opportunity for you to go out and create unique value in what you bring to the table beyond, good rates, good service, everything else. That's kind of the standard mantra. So I just wanted to toss that as well.
Yeah, and then Jill, you mentioned this is available on purchase, refi, cash out. Hey guys, we know refis are going to be, the Mortgage Bankers Association said refis are going to be down 46% this year, and we're already seeing it, right? So, and we also already know how non-owner and second homes are being affected in the QM space. So we know that no more than 7% of your portfolio can consist of second homes and non-owner occupied. Well, we're hearing right now there's a lot of portfolios out there that are about 11 to 12%. So 4 or 5% of that's not going to get done going forward. So really look to your non-QM lender to pick up a lot of that for you. So, but Jill, you mentioned purchase, refi, cash out. You know, what other availability is this on? Well, we talked about second homes and non-owner occupied. Can you do that in the bank statement program?
Yeah, so like I said, it's a 90 max LTV program, but that's really going to be for your owner occupied and second homes up to 90% on a purchase or a rate and term refi. Our cash out for owner occ is limited to 80%, and then on second home and investment, we're capped to 65 per the guidelines. I've gotten slight LTV exceptions on that. It's case by case. Again, your account executive is your go-to. They'll really structure the deal and to tell you what we can do.
Yeah, so Russ, maybe you can clarify. We have a couple of people asking a little bit more in depth on that self-employed borrower and W2 borrower. So just kind of reiterate, you know, what we can do for that self-employed borrower, backing out that income and just, you know, making sure that's all we need. Go ahead with W2s. And
yeah, so maybe to clarify a little bit on what Jill said too. So we do require 30% of their income from self-employment. So if you've got a borrower that has a self-employed business and is also W2'd, we're going to have to back out that W2 income because we're saying they're self-employed. But if you have a spouse or a qualified co-borrower that's W2'd and the other borrower is self-employed, then we're able to use both of those incomes. What I was mentioning earlier is if they're both on the same bank statement, it's just the bank statement analysis is just going to look at the self-employed income and not the W2, and then we add that back in as W2 income, if that makes sense.
Yep. And Scott's asking a question here. Scott, he's asking about what kind of rates we're going to get there. We're going to show you guys. We have a really cool quick quote tool that will show you a little further down the road. So keep those questions coming in. Just a couple other, we talked about the properties. We'll do single family, 2 to 4 units, townhouse, condos. Russ, talk a little bit about condos.
Yeah, so on condos, we can actually use non-warrantable condos across all of our programs. Not all non-warrantable condos, but basically you provide the condo questionnaire. We take a look at it. You know, it could be more than, you know, we could actually 100% investor owned as an example. What we're typically looking for is if there's major lawsuits that have been unresolved, if there's one investor that owns more than the allowable percentage for the total ownership. So there are some caveats on it, but we do look at non-warrantable condos across the board for all of our programs.
Right. Yeah, and I think a key there, what Russ just said is we're okay with 100% investor concentration, right? We get a little concerned once one investor owns more than 20% of the entire project. So just keep that in the back of your mind. Again, it's really, we're going to show you a couple of the tools. How do you find your local account executive? But really think of Angel Oak account executives as your non-QM help desk. Very responsive, very knowledgeable. And again, what Jill mentioned earlier is that prequel is not going to get published until we feel 100% confident that that deal is going to close. So a couple other questions.
Sorry, one other caveat on the condos. You know, if it looks or smells like a condotel, then we're probably not going to be able to do anything with it. So, you know, especially on condos, if it's a short-term rental market, we really want to do a deep dive on it and make sure it's not going to raise any red flags from that standpoint. So that's something good to keep in mind. Yeah, no, great answer, great follow-up there. A couple other things just on bank statements. I know we're about 25 minutes past the hour. We got a couple other really cool programs we want to share with you guys. But the couple of people, Jill, you mentioned it. I have another question that came in here about personal bank statements and being able to use 100% of that personal bank statement. Can you clarify that a little bit?
Sure. On personal statements, we typically would have to back out an expense ratio just as we would using business bank statements. But the one exception is if the borrower owns a business and has an open business bank account, we just need 2 months most recent statements on that business bank account. And we can say that the expenses flow through that account in order to use 100% of the deposits into the personal. We do want to see activity in the business bank statement to make sure that there's expenses are really running through there, but that's the way to kind of use the 100% on the personal deposit side.
Yep, I just had a $1.6 million deal that came through that was a perfect example of that. The borrower had, I think, 6 or 7 restaurants down in California and had all kinds of cash flow coming through, but wanted to use personal statements. So we were actually able to use transfers and deposits from 2 of those businesses. And seeing as the thought process is, if they've got a business account, that's where the expenses are coming out of. We were able to allow 100% of the deposits and transfers into the business account. So it was a great example of that.
Yeah, so, again, with the experience of an account executive like Russ and Jill here, they've done deals that, you might have been told no before. And the other thing really want to let everyone know, and we talked about the statistics of how many people have not closed a bank statement loan in the last 12 months. So that's around 75 to 80% have not. These borrowers, these self-employed borrowers, are very, very resourceful borrowers, and they will come directly to the source. They come to us. I get about 3 phone calls a week from these borrowers. So if you're going to be that 75 to 80% that I don't want to do it, someone's going to do it. You're going to lose that deal down the street to a loan officer that already knows how to close non-QM loans. So for everyone on this call, you're on here because you're seeing the writing on the wall. You're seeing refi slowing down. You're seeing how you want to maintain that great income you had in 2020. So I applaud you for getting on this call, and hopefully we'll answer all your questions here today. So again, we've got a lot of other things to cover, and we really want to be conscientious of your time. The next, Russ, you're going to cover our Platinum program here.
Mm-hmm. Great. So the Platinum Jumbo is a great alternative for your jumbo fallout from your traditional jumbo lenders. So the difference is that we look at these through the non-QM lens rather than the traditional underwriting guidelines. So the DTI is much more lenient. The look back on credit is much shorter. Our loan amounts can go up to $3 million and such. So let me go through the details here first. As I said, loan amounts go up to $3 million. The minimum loan amount for this product is $250,000. We do only look back 4 years seasoning for foreclosure, short sale, deed in lieu, or bankruptcy. This is good for any type of home or transaction. So owner-occ, second home, investment properties, purchase, cash out, refi. This is a full doc only program. So we'll want 2 years tax returns, the standard requirements for income. And just as a note, on all of our full doc programs, we look at the income almost identically to Fannie and Freddie for full doc. So, if the income works on your agency side and it falls out for some reason, it's going to work on our side for the full doc as well. We do have a 40-year interest only option on this. And in a lot of cases, these are great Bandaid loans. On the owner occupied and second home, there's no prepayment penalty. So if someone's, had something maybe 4 or 5 years back and they're looking to get into that purchase now and maybe come back and do a refi for them in 12 to 24 months, these are awesome options for that because, as I mentioned, the guidelines are much more lenient. We do have the 1-year tax return for self-employed borrowers on this. And again, non-warrantable condos are allowed across the board.
Yeah, Russ, you mentioned a couple things. I just want to make sure that we highlight that, this can be treated like a Bandaid loan, right? Someone maybe who's had, your traditional jumbo programs have that anywhere 6 to 7 year window of a credit event in your life where we're only 4 years out on this. So I really want to, commend Russ for covering that because that's a key. That's a reason why we get a lot of these jumbo deals here. So kudos to you, Russ. Russ, a lot of people ask, I know you mentioned the LTV. What credit score with the 90% LTV?
Mm-hmm. So we can go down, the minimum score is a 660. To go to a 90% loan to value, we need to be at a 700 score, and that's pretty much across the board. So potentially, if you had that borrower that had that bankruptcy or foreclosure 4 years out, they're at a 700 score. We can go up to 90% loan to value with no MI. So, you know, the rates are going to be a little higher on this than they are on traditional jumbos, but there's no MI involved. So when you look at the cash flow, you know, the cash out of pocket for your borrower, and just do a cash flow analysis for them, this can be still very, very competitive. So you definitely want to keep that in mind.
And Jill, I don't know if Russ said this, but and I might have missed it. I apologize. A DTI on this compared to maybe some other jumbos?
It's the same as the bank statement, 40% on the front and 50% on the back. That 50 really gives you a lot of room because a lot of traditional jumbo limits you to 36 to 43, depending on the parameters of your LTV.
Great point, guys. We're going to stick with the full doc. We're going to stick with Russ going full doc. So Russ, let's talk about our Portfolio Select program.
So this is the, you know, post-COVID, we came back with kind of a limited product profile lineup compared to what we had before that. And one of those was the non-prime program. This is probably the closest to that we've got, although it's really tailored as much for the jumbo borrowers that have had some issues as well. So we can go up to 2.5 million for a max loan amount. We can go to 85% loan to value. 2 years out on the foreclosure, short sale or bankruptcy, like I said, on the Chapter 13, we'll look at the filing date if it was paid as agreed and discharged. We can owner-occupied, second homes, investment properties, non-warrantable condos are okay, and again, up to 50% DTI. We can allow gift funds on these transactions, but not gifts of equity. So that's an important differentiation to keep in mind. We can't do interest only on this, and again, non-warrantable condos. So potentially you're looking at, with scores down to a 620 for a program minimum. If you had someone that had a bankruptcy a couple of years out, you can do jumbo loans on this, full doc. Again, to John's point on the Bandaid loans, this is a perfect example of it. And you know, these borrowers are definitely out there, so it's a great one to have in your back pocket.
Yeah, Ross, I agree with you. You know, this is a great program. Again, you know, we talk about it like internally. We call it our Waterfall of Programs, right? So if you submit a platinum bar and all of a sudden you find out, you know, wow, they had a foreclosure. You know, we just lowered that too. We had a foreclosure, you know, 18 months ago. What? We can put them in our Portfolio Select program and keep it in-house, and you know, or there'll be a slight rate increase, but you know, you're working with a lender like Angel Oak who can get them all done in our Waterfall of Programs. So, and again, you know, we're seeing as that QM box is getting smaller and smaller, we'll get our non-QM box is getting bigger and bigger. So we've got a year under our belt of how these loans have performed in a global pandemic, and they are performing really well. So again, we've had 27 enhancements in just about a year's time. There are going to be more down the road. So again, it's really important that you reach out to your local account executive so they can take you through the most recent enhancements like we had this past Friday. So,
and speaking of that, we've had them so often that I missed the new high LTV, as Jill's laughing at. So our new enhanced guidelines as of Friday is we can actually go to a 90% loan to value on the Portfolio Select as well. We were at 85, and we can go investment up to 85 now. So again, the changes are coming so fast we can't keep track.
They are coming fast and furious. That's why stay in touch with your account executive. Visit our website. It's always, you know, within 24 hours, our programs are always updated. We have a lot of great questions coming in. Keep them coming in. We really appreciate you guys investing your time and your energy and allowing us to share the most recent enhancements with you. So, yeah, Russ, and we mentioned we just lowered the foreclosure from 24 to 12 months, right? So, and then as Jill mentioned earlier, you know, we'll do DTIs up to 50% on this. So, a lot of great full doc programs for you. We've talked about bank statements for those self-employed borrowers. We just talked about a couple of really good full doc programs for you. We're going to turn it over to Jill now, and Jill's going to go over a really special program, our investor cash flow. This program has almost doubled in probably the last 3 to 4 months, and it's strictly because of what's happening in that QM space, specifically to that investor program. So go ahead, Joe.
All right, so this program is probably our simplest. It's no tax returns needed, no employment or income needed whatsoever. You pretty much know right away, looking at a credit profile, if the loan's gonna work. So if we go down to credit scores of 640 and up to an 80 max LTV, excuse me. So the max loan size, I believe it is 1.5 million. I've done them up to 2 at lower LTVs. The minimum loan size is 75,000. And the difference between this investment loan and other full doc investment loans is, again, no tax returns, no ratios. We simply look at the rents of the property versus what the new mortgage payment's going to be on it. So as you can see in these next bullet points, the qualifications based on the property cash flow, meaning the rents versus the mortgage payment. We do require for LTVs over 75% that it does positively cash flow, meaning the rents are greater at 100% value of those rents are greater than the mortgage payment. If your LTV is actually 75 or less and you have a 700 minimum FICO, we do allow that property to negatively cash flow. So that's a really unique thing. I don't know how many other non-QM lenders allow negative cash flow. It's just a great thing, especially in a high-end loan. You're going to have more issues with cash flow. And then the other thing is we can totally vest in LLC. A lot of people do use this product for business purpose. That's their job, their investment portfolio, residential property managers. So it's kind of a great program because we don't limit the amount of finance properties a person owns. There's not a limit on, 10 finance properties or 4 finance properties that jumbo limits you to. And again, purchase cash out rate term, just like all programs. We do have the IO option, the same as the rest of the programs, and then non-warrantable condos with the same restrictions are considered.
Hey, Russ, got questions are still coming in, so this is great. If you are using interest only on this, how do you qualify the borrower?
Yep. So you have to qualify on the fully ammed payment. So, obviously the interest only is going to provide some benefit for them in the cash flow. But, we're going to qualify the DSCR based on the fully ammed payment on it. This product is really, really unique in the marketplace because it could be a person's first investment property as long as they own a primary residence, or it could be their 50th. There's another cool aspect of this. We can actually do cash out on appraised value after 6 months. So if you've got someone that's fixing and flipping properties and they're putting some real value back into the property during that process, then we can actually go off the appraised value. So the fix and flippers, the serial investors that are wanting to pull cash out of their properties and put them back into additional properties is great. We can do up to 5 loans and up to $3 million aggregate. But there are some exceptions to that, as I think Jill mentioned too. If it makes sense, we can make these deals work.
Yeah, I had a AE that works for me out of Florida. She was able to get 10 deals done for a borrower because we were really putting them in a very advantageous position cash flow wise, and all the properties cash flowed really well, positive cash flow. So it was really good. So Stephanie, hopefully we answered your how we qualify a borrower with the interest only. Jill, can you kind of clarify the LLC? What does it consist of and who has to qualify, please?
Yeah, so with regards to the LLC, it does need to be for the purpose of residential real estate investment. All members of the LLC have to go on the actual loan as borrowers, and we do limit that to 2 people is the max. So to make sure your LLC is structured the way it needs to be to qualify. Great.
And then Chris, I know we answered your question in the panel here, but I do want to share this with everyone else. The question was, do we allow these in a 1031 exchange? And the answer is yes. So I know we answered that silently. Want to make sure we answer it for everyone on this call because I'm sure everyone else is thinking about that too, as you have these, as Russ said, these seasoned investors. So a couple of quick questions here, Russ. What about prepayment penalties on this program?
So yeah, on all of our investor property loans, there are prepayment penalties. It's a 3-year prepay, and this is always fun to explain. It's a 3-year prepay. It's 6 months interest on the remaining balance that's in excess of 20% of the original balance. So you just take the balance that's left, remove 20% of the original balance from that, and 6 months interest on that.
Russ, I've never known the answer to that, so thank you. I'm joking. And then talk about, either one of you guys, whoever wants to take it, talk about the forbearance policy. I know we just did it we allow it now on investor cash flow. We've been doing it on our other programs. If you guys don't mind, just, kind of clarify to some of the questions we've got here with forbearance.
Go ahead, Jill.
Okay. We just changed it. The rule was 0 forbearance allowed. Pretty much you're out of luck. And
Right.
as we mentioned the enhancements last week, we will allow it with up to 3 months missed payments or skipped payments due to forbearance, as long as they have 3 months consecutive payments by the time we close our loan.
Yeah, so this is kind of, I really want to just clarify this for people. A lot of, like your self-employed bank statement borrowers and like your investor savvy investors, they're all about cash flow. So, if they were able to take, 3 months off, yeah, they're about cash flow. So, let's not say no. Reach out to your local account executive, go over the scenario, and let's get that done. Again, interest only, a big portion for these borrowers because they love the cash flow aspect of it. And again, as that box gets smaller and smaller for investment properties in the QM space, more and more borrowers are going to come to the non-QM space for investment properties. So please definitely reach out to your account. This is big. A lot of people are, even like Jill mentioned, we just increased the no debt service coverage to a 75 LTV. If you have a 700 score, there are investors looking to invest, knowing that the long-term growth of real estate in this country is going to continue to grow. So think about that. All right, let's move on to the asset qualifier. Russ, I believe if there's no other questions, and again, we've got 20 minutes left. We want to talk about our pricing engine. We want to talk about our marketing department and how they can help you guys grow your business. So if we have a little bit more time at the end, we'll go back and answer some of the questions that we didn't get to. So Russ, let's talk about the asset qualifier program.
I just want to add one other thing on the investor cash flow. The 2 caveats to keep in mind on this are that they have to have a primary residence. So, so much of the qualification of this is based on the cash flow of the property, right? So they want to make sure that it's not being used to purchase primary. So they have to have a primary residence, and they don't want to see rural properties. This is for your cookie cutter investment property, 1 to 4 units. So they're looking for true rental properties, rental income. So just wanted to keep those in mind.
Yeah, and Russ, I'm glad you caught that. And the other thing I caught here is, the escrow waiver. We can waive escrows at equal to or less than an 80% as long as the borrower has a 700 score. Again, for that cash flow driven investor, that usually makes a big difference for them.
Great. So the asset qualifier is a no income qualifying loan. We can go up to 75% loan to value max. The minimum score requirements are 700. And, you really need a lot of money in the bank. We don't do a ton of these just because, people don't have $1 million sitting in the bank in most cases. But, this is a great program for people that want to use other people's money. They've got the money in the bank. We can do the loan amounts up to $3 million, same as the platinum minimum loan amount, $250,000. It's no employment, no income, no DTI calculations at all. All of our rates are on 30-year fixed programs. And there's a little difference on this one. We require 5 years seasoning on foreclosure, short sale, or bankruptcy. And this is only for primary residence. So it's not for a second home. It's not for investment property. There are interest-only options available. There are non-warrantable condos allowed, like all of our programs. And all assets and sources of funds have to be seasoned for at least 6 months. So you're not using, the proceeds from their house in California that they just cashed in on all the equity and, bringing it to another market or in that own market. So the funds have to be seasoned 6 months. All the required assets, basically the qualifying on this is you have to have the loan amount in your assets. You have to have the down payment. You have to have 6 months PITI and 60 months consumer debt payments. And we've got a great tool, a calculator that, when you have one of these that you think is a good option, reach out to your account executive and we'll go through this calculator with you to qualify the funds. We have to give the different asset sources different haircuts. It's like retirement accounts, stock accounts, 401k. Each of those have different percentages that will allow to qualify for those. So when you have one that you think's close, reach out to your account executive and they'll be able to help walk you through the process on it.
Yeah, Rob, hopefully that answered your question about a kind of a ratio. We do need, like as Russ mentioned, the 60 months. I've had other account executives talk about this program. If someone sold a business, this is really, really advantageous to that person. They may have sold a business, they might have a non-compete, so they're not working, or that's a person that maybe qualifies. Maybe someone who had a lump sum payment through divorce, unfortunately, but they had a lump sum payment and it's been seasoned. We're only requiring 6 months seasoning on this now. We were 12 months, I think, about 5 or 6 months ago. So now we're down to 6 months on this. So there's, again, a lot more enhancements continue to roll out each and every month or almost every other week. So that's another huge enhancement. So they didn't have to have it for 12 months. It's now only required to be 6 months. So just think outside the box. Really, we want you to be able to communicate to your referral source deals that you might be able to get done. And then what you're going to do, obviously, is reach out to your local account executive. So just like that. So hopefully the spreadsheet calculator, people are asking for that. Once we get you in touch with your account executive, they'll be glad to share that with you or even do that calculation for you. Do you have
John, the other thing that I didn't mention is you have to end up with $500,000 in the bank post-closing. So if you have all those assets in place, you still need to end up with $500,000 in the bank after the deal is done. So just a caveat on that.
Yeah, I think, as Russ said, this is not for someone who's, doesn't have a lot of assets. I have a account executive in Florida who says, a minimum of $2 million, not that high, but you do need a significant amount of assets. So we do, just to share with you, we do have an asset depletion program. Just won't cover it here in depth, but if you can use income along with assets to qualify the borrower. Not a huge popular program, but also another alternative to have that conversation with your account executive. So something like that. Guys, we're coming up on almost 10 minutes at the top of the hour. We want to show you a couple of great tools. Again, this is being recorded, and we will have your local account executive reach out to you within 24 hours, and this recording will be sent out to you no later than end of day tomorrow. So, Jill, let's talk about some of the great tools we have on our website. Let's go to our quick quote tool.
Okay, so the non-QM quick quote's really your go-to scenario runner. You just put in the parameters of whatever loan you're working with. As you can see the boxes, we need the loan amount, your credit score, your loan to value, the transaction type, is it a purchase, rate and term, cash out, is the property a 1 unit, condo, etc. And then what kind of income are we using? So John just ran a scenario where he put in an 80 LTV, $500,000 loan with a 760 FICO, which is our highest bucket for bank statements, owner-occupied purchase using 24 months personal. As you can see below, it just populated what the par rate is, meaning you're always going to see the borrower paid par rate on this pricer. We can't assume what your lender paid comp is because this tool is open to the public. So it's just giving you a general idea of what your par borrower paid rate is going to be for the scenario that you're running. And you can run that in your programs.
Yeah, so, and thank you for clarifying that, because that's been one of the questions. How does Russ, why don't you help with Jill, which she just mentioned that's par rate. Why don't you help them understand? We've had a few questions on, hey, guess what? How do I get paid? We're telling loan officers how they can make some extra money closing non-QM loans. Tell them how they get paid.
You bet. So the rate that you see here on the quick quote is the borrower paid rate. And the difference between borrower paid or BPC and lender paid comp, LPC, is basically on borrower paid, you have to add your origination charge as a cost to close in the transaction. So that's going to be cash out of pocket or out of proceeds that and that can be anywhere from 1 to 3 points. So we don't really dictate how much that is. It's up to you and your your shop to decide how much you're charging on the borrower paid side. On the lender paid comp, we have the ability to basically build some or all of your compensation into the rate. So you would increase the rate to cover some of your compensation. Depending on which program you're on, it's going to be anywhere from 1 point to 2.5 points that we can build into the lender paid comp. So the best thing to do is reach out to your AE. When you see this as the borrower paid rate, reach out to your AE. They'll be able to tell you exactly what you can do on your lender paid comp. And then you also have the option of either buying down, not to confuse things too much, but you have the option of buying down the lender paid rate or buying up the borrower paid rate to cover some of your closing costs. So, this is a great starting point in the pricing on the tool, and then reach out to your AE and, kind of run the scenario past them, run the pricing past them, and see what the best structure is for you. When we complete quick qual as well. Yeah, sorry, John. When we complete the pre-qual for you and send that out, it's going to show you all the pricing options available. So you'll really be able to choose what's customized best for your borrower's situation and for you guys. So.
Yeah. So thank you. And Scott, I know you asked a question earlier regarding rates and stuff. So again, Jill mentioned it earlier. All these rates are 30-year fixed. So just a couple things I want to change here. And again, it's a very dynamic, easy to use tool. Let's just say we change this to 90%. You're looking at a rate of 5.25 on a 30-year fix. That's par, right? That's one loan, as Jill said earlier, one loan, no MI for a borrower using alternative income documentation as bank statements. This is a very, very, very good rate. Jill, let's run another scenario using investor cash flow. No. You there, Jill?
Yep. Yeah, so
Okay.
John just changed the parameters. All he did was change the LTV to 75 and doing investment property on the DSCR investor cash flow program. Again, it's showing your par rate as 4.75. It also highlights, the seasoning per to match, just in case you're having any questions about little parameters. And the box below even tells you program requirements, just to make sure that you're meeting everything. But again, your account executive is your best tool. There are sometimes exceptions to these little things. It really depends. So they're really your best resource in determining your final price and if your loan's going to be pre-qualified.
Hey, John, would you mind running a full doc scenario real quick? Just wanted to show kind of you're coming up with 2 options on it.
Okay, Russ, anything for you. Owner occupied?
Yeah, sure. So, whenever you run the scenario, as soon as you have enough information to show what it qualifies for, it's going to show the program and the rate and everything. But like on the full doc, it's going to show 2 options. And what I wanted to point out is the differentiators on this in most of the situations is going to be the bankruptcy seasoning and the housing event seasoning. So foreclosure or, deed in lieu. So make sure you're looking at the bankruptcy and housing event seasoning and also the reserves over on the right. And that'll kind of help you qualify the borrower up front. And then on the locks, these are automatically locked on the non-QM side for 45 days. And that happens when you initially disclose the loan. So you don't have to worry about, going through a lock process in addition to all this. So thanks.
Perfect. Thank you, Russ. Yeah, again, you can see how easy this is to use. Just changing a couple fields. It's a great, your AEs are available 23 hours a day. This is available 24. So, and the nice thing about this, you do not need any credentials to log in here. So, but we are going to go to a part of our website that you do need credentials to log into. So, and Jill's going to kind of take us through this. Let me make sure I've got my login credentials here, Jill, before we. Oh no, I'm sorry. Russ is gonna take us through that. Sorry about that.
So you log in. No. Go ahead.
I think the biggest thing about this whole process for the non-QM, kind of like we said at the beginning, is this is an opportunity to differentiate, right? This is something new in your pocket that you can bring in, take to your referral sources and show them, something new, something they don't know about. And our marketing team is by far the best in the business. They do an amazing job of not only helping us put these things together and provide the tools to help make us successful on our side, but also you guys. And these marketing tools that we have available, basically you can log in and we have white label presentations and flyers that are tailored to each of these program niches that we have. So bank statement program, the investor cash flow. One in particular that I like really, really well is we've got a whole PowerPoint presentation put together for realtors that basically you can download, you can drop your information into, your disclaimers, your contact info, and it walks these realtors through these different scenarios, and it's presented with you guys as your own portfolio products that you're presenting to them. And I've done a lot of these presentations with some of my customers where we'll get in front of a group of realtors, and I'll kind of lead off by saying, by a show of hands, how many people in this room have had a buyer that was self-employed that didn't qualify because they write everything off on their taxes? And invariably, almost every hand in the room goes up, right? So you're making an impact with these. And the same thing on the investor cash flow. How many people in this room, maybe you yourself, Mr. Realtor, have run into scenarios where you don't run into debt to income ratio issues on buying an investment property, or you're fixing and flipping, these type of scenarios. So this presentation in particular really walks them through that process and puts you in the driver's seat of being a real trusted advisor and someone that is bringing something different to the table.
Yeah, Royce, I think you hit the nail on the head. You're not just walking into a realtor's office or a referral source saying, hey, I've got great rates and great service. You're really bringing that content, different content, ways that they can close or transact more homes, or if it's with a CPA, drive business through a CPA. We will present, and I don't know if the PowerPoint's up here on the screen here, Russ, if you were, yeah. So we tell you where to go get your referral sources, like through realtors, through, large banks. They can't do non-QM. So what are they doing with their fallout? CPA and tax preparers, they do a fantastic job. They do a fantastic job writing everything off on their clients' taxes. Therefore, they have a database of people. Financial planners, because we don't require 20% down on all our programs. We go as little as 10% down. Financial planners don't want people taking their money out of the market, what Russ said earlier. They'd rather use other people's money. So that's a way to go to the financial planners. You can go to business bankers. You could go to builders, developer, hard money lenders. They're looking to get a lot of that money back off their books. They can refinance that investment property into our investor cash flow. So there are ways. Our AEs are subject matter experts. You've seen Russ, you've seen Jill. They will go in and present on your behalf. They'll either go into the office with you, or they'll do it through a Zoom. Did one here in Dallas about 2 months ago. The loan officer got 2 investor cash flows. They've already closed. So rely on your subject matter experts, our account executives throughout the country to help you close more loans and help you solidify those referral sources. Because if you go in there with them arm in arm, we don't say anything about Angel Oak during this realtor presentation. We just go in and say, hey, Matt Jones at so-and-so ABC Lending, go to Matt. Matt's your go-to person. We're just one of Matt's investors. This is the most powerful presentation you can have an account executive do on your behalf. So I know we are at the top of the hour. One other tool I did want to show everyone is, we talk about how do you find your account executive? Well, we've got this map right here. You can see Russ here. We could show Jill. Jill, are you on the? Nope. Yeah, sorry, you on the? Sorry. So you can see Jill right here and all the other local account executives that you have access to. So before we say goodbye, I want to throw it over to Russ. Any last words, Russ?
I just say, I think a lot of people have looked to non-QM as kind of the, well, it fell out of agency guidelines. Sure, I'll give it a shot. And I think hopefully what you see from this is that this is a real opportunity to proactively go after this business as a replacement for the refi business that's drying up, And like we keep saying, you know, as a differentiator, not just something that's in spite of, you know, the agency fallout. So I'd really encourage everybody to, you know, talk to your AE on a regular basis, get to know these programs, use us as a resource to help you go out and differentiate yourselves and replace the revenue that's kind of dried up over the last few months and looks like it'll continue to.
And Jill?
Yeah, just to touch on that, I mean, obviously, like Russ said, your account executive is really your structure specialist. They should be your go-to to try to save as many deals as possible. But why Angel Oak? You should use us for non-QM because we're vertically integrated, meaning our products are our own. All the decisions are made in-house. We're not waiting on some outside party to get involved and have to review things, and the loan just sits. Our turn times are pretty much that 24 to 72 hour window. So it's just the ease of working with us really makes the difference. And the pre-qual being done up front, it should be a pretty clean scrub, and you know right away that your loan's going to go through smoothly.
Yeah, Jill, great couple points I want to really hit on. Jill, structure specialist, I love that word. So, and then, you know, the vertical integration is key. The 27 enhancements we've done since May 1st are key. You know, I just think, you know, in technology, we're continuing to add technology. And as Russ said, you know, make this part of your everyday speak. You know, as that box is getting smaller in that QM space, specifically in the second home and non-owner occupied, you really need to embrace a non-QM lender. Also, we didn't even talk about how QM is tightening up the high risk loans, greater than 90 LTV, DTIs over 45 and credit scores under 680. You know, only 3% of your business can be refied in that high risk category and 6% purchase. So that box is getting smaller and smaller. So it's really up to you. And obviously, you know, almost 200 of you took time out of your day today, and we appreciate you being here for us to inform you and hopefully make you say, okay, I'm tired of sitting on that non-QM sideline. I'm getting in the game. We've seen record month after record month. Please reach out to your local account executive, and we will help you definitely close more loans in an easy, timely manner. So on behalf of everyone here at Angel Oak, Russ, Jill, appreciate you guys killed it today. And we look forward to working with you and looking forward to hopefully helping you grow your business the rest of this year and into 2022. So thank you, everyone.
Thanks, everyone.